Hello everyone, Clifford Bennett, Chief Economist, ACY Securities. I trust the week is starting well for you. Some big news breaking, of course, and it's been a build-up of news on the oil front. As you know, I've been suggesting buy oil for some time, the last week or two, couple of weeks, sort of cautiously buy and then more aggressively buy, and it's certainly rewarded the longs today with a big leap higher. 8% at one stage, a bit of a pullback now, but it's probably going to be a little bit volatile and consolidating, but will remain firm to higher over coming days and weeks and perhaps even months. Demand for oil remains strong around the world. Yes, the global economy is slowing, but not by 30% or 40% the way the oil had been priced. And of course, the West wanted to institute, the US mostly, and NATO wanted to institute a cap on oil prices coming out of Russia. Japan broke with that today, so it's not just about Saudi Arabia. Saudi Arabia's sort of really put together about, it's 1 million in the headline today, but it's about 2 million barrels reduced output over the last month or two. So that is significant. And also it's a bargaining chip at the table when it discusses oil supply with other oil nations. So it means that the tap is going to be held relatively tight for the flow of oil for the foreseeable future. And at the same time, as I was just saying, Japan has announced that it is buying Russian oil above the price cap. So as an ally, in this union against Russia, it's breaking ranks and will be buying oil above the price cap because it needs energy, of course. And that's been the problem all along with all of this. It's been, again, massive market intervention, which never ends well. The West created problems for itself. Some people in the West have taken advantage of that, of course. We've seen some record profits here and there, and we've seen one country begin exporting LNG that it didn't normally do in a far larger way than it had ever previously done. It's funny how those things work out. But massive market intervention only ever ends badly. I do see the oil price continuing to firm, and in fact, the oil price could move back as high as $95 in the months ahead, perhaps not immediately, but certainly in that direction. As I said, that big spike higher on the morning trade in Asia may have been overdone. We could see some volatility in the short to near term, but overall the fundamentals are very much in favor of oil moving back $85, $92, maybe $95. In other news, we saw some inflation data in the US on Friday, which really was a welcome relief. The PCE data dropped to 0.3%, and that offered some relief to the reacceleration we had seen over the previous 2 months. So that was good news on the inflation front and made people a little bit happy with buying equities on Friday. But then, of course, this news about the oil price today is significant. And we shouldn't think of oil as being just one component of, the CPI inputs, because basically every other input into price pressures in the United States and Europe is already fully stretched. So when the oil price moves higher, almost instantly gasoline prices, particularly in the US, are going to move higher. And that will flow through very quickly to the pricing of all goods and services in the United States. In other words, there's no sort of pricing gap or cushion, if you like, to absorb even short-term energy cost spikes. And so this will show up in the US CPI reasonably quickly, perhaps even as soon as next month's data, but certainly the month thereafter. And the Federal Reserve will be very much aware of this. So the Federal Reserve is not going to, if it was thinking, it might pause at the next meeting or, have a lower terminal rate than it previously thought. So we've gone from thinking we're going to have a good, strong terminal rate, which we've been probably the vanguard of in forecasting around the world for the last year and a half, a high terminal rate to, a reduced terminal rate because of the banking crisis. Banking crisis is not center stage, but by the way, it's still happening in the background. People just don't want to give it the headlines at the moment. There's a lot of stress out there in the banking world, particularly in regional banks in the US and some banks still in Europe as well. But if that banking crisis can be kept out of the headlines, put on the back burner a little bit, side stage if you like, hopefully resolved, but we don't know if it will be, that was encouraging equity buying. But if you now, and it was encouraging the view that the Fed had to have that lower terminal rate. But now with a rekindling, and a rather fierce and ferocious rekindling of the oil price, this means interest rates may well end up going to that previously thought much higher terminal rate. So this isn't a daily or weekly event that the oil price is going higher in terms of what the Federal Reserve will be doing. It could be a mammoth input to the Fed funds rate, seeing it go 100, 150 points higher this year. And you couldn't even rule out 175 points higher this year. But I think the 100 to 150 points higher than where we are is now looking almost likely. I mean, the lowest I could see is 75 points higher from where we are, and the market isn't even pricing that. And we're never going to see the cutting of interest rates that the market keeps pricing. The market was pricing interest rate cuts a year ago. In the next few months they'll stop, they'll reverse, they'll pivot. It's all been a nonsense. I laughed at it in real time, all the way through. It's always been a nonsense. It was never going to happen. I think we're the only people who forecast this correctly. The pivot was never going to happen. It was great for generating all sorts of volatility in equity markets, which is great for the big institutions in the US to gather in their brokerage fees. But the pivot was never going to happen. And now, with this higher oil price scenario, we are going to see much higher Fed funds rates still. So exciting days still ahead, challenging times for equity markets still ahead, because remember, US consumers, US businesses are going to continue to be hit by both the higher energy costs, the higher inflation, and add on top of that, higher borrowing costs and tighter credit. It's a little bit of a crunch moment for the US economy, really. So that US economic recession that we got in the first half of last year, we correctly forecast that technical recession in the first half of last year. I'm still seeing risk of another recession sometime this year in the United States. Meanwhile, people will still want to buy the US dollar as a safe haven, which is a madness all of its own. And that could see the euro and the Australian dollar a little bit lower. Gold has been sold off, but I would be looking in coming days to be a buyer of gold. But I do think oil will continue its march higher, but not without volatility. Have a great day, and thank you very much.